Now speaking, Kevin Lewis, Vice President, Investor Relations. Before we begin, I want to remind you that some of the information shared during this call may include forward-looking statements. These statements are based on certain assumptions and are subject to risks and uncertainties. Please refer to our SEC filings for a detailed description of these risks. We do not undertake any obligation to update these statements as actual events unfold. Now speaking, Dave Burritt, President and Chief Executive Officer. Digitization. We are investing in digital capabilities to drive operational excellence and customer value. We are leveraging the power of data to drive better decisions, faster. We are using advanced analytics to optimize our operations and improve our customer experience. We are also investing in digital capabilities to drive operational excellence and customer value. We are leveraging the power of data to drive better decisions, faster. We are using advanced analytics to optimize our operations and improve our customer experience. We are also investing in digital capabilities to drive operational excellence and customer value. We are leveraging the power of data to drive better decisions, faster. We are using advanced analytics to optimize our operations and improve our customer experience. U.S. Steel delivered a strong second quarter, generating $804 million in adjusted EBITDA and 16% EBITDA margin, including an industry-leading 23.5% adjusted EBITDA margin for its mini-mill segment. The company is on pace for another record best year of safety performance following a record best in 2020, 2021 and 2022. U.S. Steel's flat-rolled segment ran at an adjusted utilization of 86%, and its mini-mill segment ran at 91% utilization. The company has returned an outsized amount of cash to investors and stock repurchases since the fourth quarter of 2021, nearly $1.2 billion or approximately 18% of its market capitalization at quarter end. U.S. Steel is advancing strategic projects on time and on budget, and is transitioning to a less cost, less capital, and less carbon-intensive business model to become the best steel competitor. The company is investing in decarbonization, deglobalization, and digitization to become the best steel competitor. U.S. Steel is producing non-grain-oriented electrical steel on time and on budget, and is constructing a new continuous galvanizing line at Big River Steel slated for startup next year. The company is building Big River 2, a state-of-the-art mini-mill, which remains on track and on budget for a 2024 startup and in line with its $3 billion budget. U.S. Steel is investing in its iron ore assets to add DR-grade pellet capabilities during 2024, which also remains on time and on budget. The company is leveraging the Inflation Reduction Act and bipartisan infrastructure law to invest in America, and is leveraging the power of data to drive better decisions, faster. Now speaking, Jessica Graziano, Senior Vice President, Chief Financial Officer. Good morning everyone on the call. We had a strong second quarter with sizable sequential increases in both adjusted EPS and adjusted EBITDA. Adjusted EPS of $1.92 for the quarter was up nearly 150% sequentially, driven by higher net income and a lower share count from our buyback activity. Adjusted EBITDA of $804 million was up about 90% sequentially, due to higher steel prices across our flat-rolled and mini-mill segments and in Europe, better mix as we responded to customer demand, and continued cost improvements. We generated over $100 million of positive free cash flow in the second quarter, and ended Q2 with approximately $3.1 billion of cash and total liquidity of $5.5 billion. Our leverage at June 30 was 1.8 times adjusted debt to EBITDA, well below our through-cycle target range of 3 to 3.5 times. We returned $75 million in share repurchases and $11 million in dividends to stockholders in the second quarter. We are nearing completion of our current $500 million repurchase authorization and have nearly $1.2 billion of buybacks completed since Q4 2021. We are also seeing our key in-flight initiatives come online, such as Big River, which is expected to generate over $1 billion of annual through-cycle free cash flow once Big River 2 is at run rate. In the second quarter, our flat-rolled segment delivered EBITDA of $377 million, up over 2.5 times from Q1, due to higher steel prices and a benefit in mix. The mini-mill segment was the star of the show this quarter with segment EBITDA of $173 million, up nearly 3.5 times sequentially, in large part from higher steel prices. Our European operation saw a meaningful improvement in the second quarter with $97 million of EBITDA, reflecting price and volume tailwinds and lower energy costs. Tubular delivered a very healthy 42% margin for the quarter. For the third quarter, we expect flat-rolled results to reflect lower steel prices, mini-mill results to be lower sequentially, and Europe to be pressured by market dynamics. We expect third quarter adjusted EBITDA to be between $450 million and $500 million. Our stock provides a unique opportunity for investors to invest in a growing business with a transformed balance sheet and continued and meaningful direct returns to stockholders, all at a significant discount versus peers. Now speaking, Dave Burritt, President and Chief Executive Officer. In the second quarter, U.S. Steel delivered record safety performance while advancing strategic investments on time and on budget. The company is focused on the things it can control to get to its best for all future faster. U.S. Steel's best for all strategy is setting it up to capitalize on favorable external trends to create tremendous opportunity for the company. The company is entering an exciting time in the domestic steel market and is very bullish for its future. Now speaking, Kevin Lewis, Vice President, Investor Relations. The Inflation Reduction Act and Infrastructure Bill are expected to have a positive impact on U.S. Steel's operations. The act is designed to reduce inflation and stimulate economic growth, while the infrastructure bill will provide additional funding for infrastructure projects. This will create more demand for steel products, which will benefit U.S. Steel. We expect the Inflation Reduction Act and Infrastructure Bill to have a positive effect on our operations in the short term and long term. We are confident that these measures will help us to continue to grow and expand our business. Now speaking, Dave Burritt, President and Chief Executive Officer. The Infrastructure and Reshoring Act, IRA, and the Infrastructure Bill offer a unique opportunity to capitalize on the current steel cycle. Our strategic projects position us to benefit from the favorable macro trends. The IRA bill should be renamed the Manufacturing Renaissance Act, as it is critical for industrial decarbonization and includes steel and iron making, confirming the important role our business plays in U.S. manufacturing. This is all about reshoring and our mantra of mine, melted and made in the USA. These initiatives will help us to capitalize on the current steel cycle and benefit from the favorable macro trends. Now speaking, Rich Fruehauf, Senior Vice President, Chief Strategy and Sustainability Officer. U.S. Steel is well positioned to benefit from the Infrastructure Bill and the Inflation Reduction Act. The Infrastructure Bill includes Buy American provisions, which will benefit U.S. Steel as they make the best American steel. About $220 billion of the infrastructure bill has been announced and projects are expected to start in the second half of the year. The Inflation Reduction Act includes $370 billion in climate investments, which could be a potential tailwind for steel and the technologies that will be developed to allow the industry to decarbonize. U.S. Steel has already set goals to reduce emissions intensity by 20% by 2030 and is positioned to benefit from these potential future funds. Exane BNP Paribas analyst Tristan Gresser inquired, could you provide an update on Q2 volume numbers, particularly the decline in external shipments at Big River? What are the expectations for U.S. volume into Q3? Is the volume guidance by division still valid? Has there been a shutdown of a blast furnace for maintenance in Europe, and what does that mean for the volume guidance? Dave Burritt replied, yes, Big River Steel has been a great success story. They have shown remarkable agility and have quickly become a leader in the industry. Kevin, can you provide more information on their volume and then answer the question related to Europe? Kevin Lewis replied, sure, Dave. We saw a sequential decline in shipment volumes from our mini-mill segment in Q2, which was largely due to the order book in that quarter. We expect shipments to remain slightly below 0.5 million tons in Q3. Across all four of our segments, we anticipate a slight decline in shipments in Q3 compared to Q2. As for USSK, Jess will comment on the blast furnace. Jessica Graziano replied, we are taking advantage of the seasonally slow summer period, specifically August, to do a planned outage in Slovakia. This outage began on July 17 and will last approximately 50 days. This is normal timing for us during this period. As a result of this outage, shipments are expected to be 100,000 tons lower than Q2. However, we anticipate that shipments will exceed 1 million tons in Q4. We are monitoring demand and production closely to ensure that they remain balanced. Dave Burritt replied, I believe Europe has been managed well and is very agile in responding to market conditions. They have achieved impressive safety results. This team knows how to run operations and can quickly adjust when needed to ensure EBITDA is positive. Exane BNP Paribas analyst Tristan Gresser inquired, what is the status of your decarbonization plan in Slovakia and how does it impact your re-rating story? Rich Fruehauf replied, thank you, Tristan. We are pleased that the Slovakian government approved our grant application for €300 million for decarbonization under the Recovery and Resiliency Plan. To move forward, we need a timeline extension for use of those funds, additional funding from the EU Modernization Fund, and investment partners to join us in this project. We also need competitive, long-term electricity rates. All of this is subject to our board of directors' approval. The facility has been profitable through cycles and is well equipped to handle challenges. We will assess the situation after the September elections. Dave Burritt replied, this asset has been a great benefit to us, and despite the challenges posed by the war in Ukraine, our employees have done an admirable job in providing support to those affected. We are well positioned to assist with the rebuilding efforts when the time comes. Morgan Stanley analyst Carlos de Alba inquired, Dave, could you provide some insight into how your steel is performing in the auto feed market relative to other flat steel producers? Dave Burritt replied, "Thanks for the question. We're focused on creating mutually beneficial opportunities with our customers. We've gained more market share with auto OEMs by having a value-oriented approach. Our customers recognize that we're not just standing still while others are investing in the future to meet their needs. We've improved our balance sheet, funded our strategic Capex program, and our strategy in the auto market is paying off. Customers are coming to us, asking us to do more. It's clear that those who focus on value, rather than volume, are the ones who earn market share." Morgan Stanley analyst Carlos de Alba inquired, "What is the expected ramp-up of the NGO line after it starts later this quarter?" Dave Burritt replied, "Thanks for the question. Achieving the right product mix is essential to unlocking the full potential of the NGO line. We are listening to our customers and responding to their needs, such as thinner or higher silicon content. This will result in higher price premiums and other benefits, which we anticipate will lead to $140 million in EBITDA by 2026. Rich, do you have any additional comments on this?" Rich Fruhoff replied, "Dave, we're in a great position ahead of the startup of the NGO project. We've already cold commissioned critical components and have been working closely with our customer base to accelerate trial and qualification timelines. We've sold the first volumes just last week and are confident we can get some EBITDA off the line this year. We anticipate reaching a run rate of around $140 million by 2026. Dave Burritt replied, "The commissioning process is going very well. Our experienced U.S. steel team has been making electrical steel for 20 years, and the partnership with our European team has enabled us to become more agile and knowledgeable. This has resulted in a successful transfer of expertise from Europe to the U.S., which is making a positive impact on our commissioning process." Credit Suisse analyst Kurt Woodworth inquired, "Could you provide an update on the plans for Granite City and the tentative agreement with SunCoke to repurpose furnaces into pig iron facilities? Does the $1 billion of free cash flow to the mini-mill segment assume any captive metallics? How should we think about potential economics of backward integration on metallics at Big River 2? Dave Burritt replied, "Thanks for bringing up our competitive advantage with our iron range. We have a low cash cost in North America, which we are taking full advantage of with the new pig facility in Gary and the float plant that are both on time and on budget. As for Granite City, Rich is closely following the discussions and I don't have much to update you on at this time." Rich Fruhoff replied, "Dave, you've identified the key points. We've seen 500,000 tons of pig iron come out of Gary and flow to Big River, resulting in meaningful cost improvements. We're continuing to have conversations with SunCoke regarding the Granite City project, and we hope to reach a mutually acceptable agreement." I'll now turn it over to Kevin to discuss free cash flow. Kevin Lewis replied, "Kurt, great question. Our projections for Big River free cash flow do not assume any additional benefits from future metallics investments. We are currently leveraging the capabilities of our pig iron asset to supply our operations with cost-effective internally sourced pig iron. This could create additional value within the mini-mill segment and provide us with more opportunities to extract value from our mining assets. However, these potential benefits are not included in our current assumptions." Credit Suisse analyst Kurt Woodworth inquired, "Could you provide updated Capex guidance for this year and next year? What would prevent you from increasing the dividend or becoming more aggressive on buyback?" Dave Burritt replied, "A great question. Our capital allocation process is something we're constantly evaluating and refreshing. As Jess mentioned in her remarks, we are currently taking a closer look at it. We have been generating strong cash flow and putting up good numbers, and our capital allocation strategy has been serving us well. Jess, could you please provide an update on our Capex and how it fits into our capital allocation strategy?" Jessica Graziano replied, "Great question, Kurt. Our 2023 capital spending is still estimated to be around $2.5 billion, primarily for strategic in-flight initiatives. For 2024, we anticipate around $1.40 to $1.5 billion in Capex, including an additional $800 million in strategic Capex. We believe there is a path to positive free cash flow in 2024, which gives us optionality in terms of capital allocation. We have a strong balance sheet and are focused on delivering our initiatives on time and on budget. We also plan to prioritize direct returns to our stockholders through a new share repurchase program and a refreshed dividend policy." Dave Burritt replied, "I'm confident that our board understands our best for all strategy and the three big goals that come with it: best operations, best relationships, and best improvement in EBITDA multiple. We're committed to making the improvements that will make our stockholders pleased. Our board is challenging, but there's no distance between us and them. We're all working together to achieve these goals." Citi analyst Alex Hacking inquired, "Is there any Capex from existing strategic projects that will carry over into 2025? Jessica Graziano replied, "Yes, that is correct. We anticipate that the majority of cash outflows related to this project will be completed by the end of 2024. Citi analyst Alex Hacking inquired, "What is the outlook for the tubular segment in the midterm and beyond?" Dave Burritt replied, yes, the tubular segment had a great first half with $1,700 a ton EBITDA. We've made significant improvements in our cost structure and strategic focus to capitalize on the strong market backdrop. We anticipate continued success in the second half of the year, particularly with premium connections performing well. Jessica Graziano replied, our tubular segment continues to perform at high levels due to structural changes we've made, such as focusing on strategic basins, premium connections, and leveraging our improved cost base with our Fairfield Eve. We're monitoring headwinds such as imports, inventory levels, and the rig count. Distributor inventories are currently running a bit high at 7 months, so we expect Q3 volumes to be weaker sequentially. However, we anticipate that inventory will rebalance by the end of the year, allowing us to return to 120,000 to 130,000 tons per quarter. Dave Burritt replied, thank you for joining the earnings call. We remain focused on delivering our best and following our capital allocation framework. Our best for all strategy will generate industry-leading growth and returns to our stockholders in the near term and long term. We are investing in our business to be the mined, melted, made in the USA steel supplier of choice for a reshoring of the nation. We issued our 2022 ESG report reaffirming our commitment to sustainable steel making and a greener economy. Our operations are generating significant cash, $894 million year to date. We rewarded investors with another $75 million of stock repurchases in Q2 with more to come. We look forward to creating stockholder value together.